In today's video, I am going to talk about a case of an individual looking to start a whole life insurance policy beyond the age of 60. He's actually 62 years old at the time of starting the policy, or I should rephrase, when we're looking at options, because he's considering starting a policy if it makes sense. Really, the purpose of us meeting with him in this video is to help determine if it does make sense as he sees all of the options. That's how we work with individuals. But what's interesting about this case is he is looking to start his own business. He has assets from his last career, so what he's done for the majority of his life. He was a college professor at a major university. He's got a background in entrepreneurship and technology. So the business he's starting has to do with helping startups really propel their business. He invests in them if they fit his investment thesis, and if they do well, obviously he participates in the growth. That's his plan, and he's got a lot of knowledge and experience there in helping other companies. Just when he was a professor, he could not participate in any of the growth of the companies based on his career role or based on his job when he worked at the university. But with all that said, he's got assets on hand, which will help him start his business. That's what he wants to do, and it sounds like a ton of fun, to be honest. I love that kind of stuff, business in general. But what we're looking at and why he reached out initially is because instead of just taking the assets he has on hand and using them to fund his business, which he can absolutely do, and he will likely do well, he wanted to see what it will look like if he takes some of the assets he has on hand, moves them into a high cash value life insurance policy, and then uses the policy for his business. A lot like a personal line of credit. A ton of real estate investors and business owners we work with will really view a cash value life insurance policy as a high yield savings asset that they can leverage like a personal line of credit, which we'll look at different models as we progress through this video. So what we're going to look at in terms of options is as follows, or steps, I should say. Step one, policy options. So we've got different funding amounts there. We see $75,000 per year for 10 years, and then a $250,000 lump sum and $60,000 per year for 10 years. We'll get to exactly how we came up with those numbers, and then we'll look at different models as well. But those are the different options with respect to funding we're going to look at. Then two, company options. MassMutual and Guardian are primarily who we looked at. That is primarily who our company uses at this time. And we did discuss other companies and also the question, why the major mutuals? Why not other products? Why do we recommend those companies? I'll go through exactly that as well. Three, specific details on designing his whole life insurance policy. He had a number of goals here. High cash value upfront, primarily for opportunities. Number two, strong long-term performance. He does not want to give up long-term performance just to have a high upfront cash value. Number three, flexibility. One of my favorite words when it comes to cash value life insurance. Flexibility to increase and decrease payments as time passes. I don't want to be locked into a bill where I'm obligated to pay the same premium every month, every year. That's a big turnoff when it comes to whole life insurance. How do I take the core benefits of a cash value life insurance policy? Core benefits being as follows. What are they? If you've seen some of our videos, you know this already. Safe, liquid, and tax-free area to position money. Specifically focusing on the cash value. Safe, the net internal rate of return, typically falls between 3 to 5%. Liquid, I can access money anytime through the loan feature. And then tax-free, if I do things properly, meaning I don't trigger a modified endowment contract, cash the policy out with a gain, or any other taxable event, which if you are curious about what can trigger a taxable event on a policy, I would encourage you to check out our video that goes through taxes on whole life insurance policies. So specific details on designing the policy. And then number four, policy in action, using his policy for opportunities. So let's get on into it and have some fun. First, a little bit of information on his situation. So, former college professor at a major university, that is his background there. Oopsie daisy, that's much better. And again, he taught in the field of entrepreneurship and technology. So he's looking to leverage his knowledge and experience in working with other business owners to start his own company, particularly working with startups. He's got a lot of knowledge there. So he's interested in a policy, or I should say one, to place cash, assets that he already has, into a policy and then have the ability to leverage that cash value in the policy for opportunities. The death benefit is also valuable to him from an estate planning standpoint. So we did want to highlight that, and because he did mention it. Most we work with will often hear, I don't care about the death benefit, Steve. We're interested in the cash value. He is concerned about the death benefit in his case. So in his situation, he's 62. He's built up assets over the years. So he's in a situation where he does not need to fund the policy based on cash flow coming in. Or a lot of times when we work with a business owner, you might feel that you're in this situation is your cash flow fluctuates and you want the ability to fund the policy based on your cash flow. We did set it up to do that. However, in his situation, he's got assets on hand and he can simply shift those assets over to a cash value life insurance policy. What he specifically wants to do is he does have a pension that he has not taken yet, but he can flip that on anytime. Right now, we're looking at different options to see what's the best pension option to take. And as far as options, he's got more than two, but the two we're looking at right now is number one, does he take the maximum lifetime income, which will give him $100,000 per year. That is before tax, so that's a gross amount. Or number two, does he take a lump sum amount of $250,000 and then a lifetime income amount of $78,000 per year. And that is, again, before tax. So it's a gross dollar amount. And we do need to factor that in. So when we looked at numbers, typically what we like to do there is just account for what tax bracket he'll be in and then round things down to be ultra conservative. Of course, as we work with tax attorneys and a CPA, we get exact numbers, but we do like to start with just ballpark figures so we can see what would it look like if I move forward with this strategy. Just give me an idea to start with. All right. So beginning with number one, policy options, funding, $75K per year for 10 years, and then $250,000, that's the lump sum, and then $60K per year thereafter. Where we came up with those numbers is as follows. Number one, the $75K per year for 10 years. Where we came up with that number is this involves the number one, maximum lifetime income option from his pension of $100,000 per year. Where we came up with the $75K per year for 10 years is just we accounted for income tax coming out of the $100K and then rounded things down a bit. He may get more than $75K per year, but again, shooting it conservative. This way, if I can pay in more money, it looks even better. I don't want to tell you, here it is with $100K. Oh, but we can only pay in $75K. Just setting expectations. Let's look at things conservative. So 10 years. We do have the option to fund it longer than 10 years. We can also fund it for a shorter period if desired. The next option here, we've got a lump sum. So we're going to look at a net of $250,000 paid into the policy. And then we've got that $78,000 per year coming via income. Here, we're going to look at $60,000 per year for 10 years. So again, rounding things down. Now, regarding the lump sum option, something very important I want to hit on here is, would it make sense, so if you're new to this, let me ask you this question, would it make sense to take $250,000, move it into a policy, so let's say year one, you fund the policy with $250,000, and then the second through 10th year, you fund the policy with $60,000 per year. Would that make sense? Because with a life insurance policy, if I have a dividend rate, say of 5 or 6%, and I just plop $250,000 in there, will that begin to earn interest right away? The answer is yes, but if I want to start off with $250,000, I'm going to need a very high death benefit to accommodate the needed MEC limit. That's that taxable line on a life insurance policy. So my point is, this option does not make sense. And if you'd like to understand that further as to why that would not make sense, and what you'll see will make sense, is actually breaking that lump sum up over 3 years. So $250K divided by 3 years comes out to $83,000 and change. It's like $83,333. So what we did here was just round down again. $80,000, but he's also funding the $60K per year, beginning the first year. So in the first year here, it'd be $80,000 plus $60,000, which comes out to what? $140,000. So what we're doing is moving that $250,000 lump sum into a policy over 3 years, which is 80, rounding down, plus 60 for a total of 140. And then once the lump sum is exhausted, then he's just funding $60,000 per year from year 4 through year 10. So we did look at different funding scenarios when I analyzed it, and at his age of 62, breaking that lump sum up over 3 payments was the most efficient strategy. This also takes into account the fact that he's continuously making payments beginning year 4. So going back to this, if you have a lump sum and you'd like to understand more of the mechanics behind it and why it makes more sense to spread a lump sum out, move it into a policy over several years instead of just a one-time lump sum, I would encourage you to check out any of our videos that go through how to design a policy for maximum efficiency when working with a lump sum. So with policy or the policy options and funding, option 1, $75K for 2 years. Option 2, $140,000 years 1 through 3, followed by $60,000 per year, years 4 through 10. Company selection. Actually, before we just jump into company selection, let's just sample real quick what we've got here. So the samples, we're going to go through some of the illustrations as well, but what we see here, what do you notice on the left? An example with Mass Mutual. $75K per year, funded for 10 years. Then we see Guardian L95 with their dividend option, and then the same Guardian L95, but with their indexed option. These two are the exact same product. What that indexed option is just a rider that can be attached to the policy. And what I really like about that rider is we can attach it, and if we have it at 0%, it'll always function like this. There's no fees or anything like that. If we leave it at 0%, if we turn it on, there is a charge. Presently, it's 2%. The cash value figures reflect the net values, net of the charge that is assessed. However, you can go back and forth between the dividend option and indexed option. You can go 50-50. You can be creative with that. How I like to explain it in simple terms is that it grants a little bit greater earning potential on your cash value. However, if you attach it and you just don't feel comfortable using it at all, you can do that. If you leave it at 0% forever, it's the exact same thing as if you never had it in the first place. But we did look at this option because we did discuss it during our meeting. He did have a couple questions on it. But the options we looked at, so here's option A, the $75K per year for 10 years. And then let's take a look at option B, which is the front-loaded policy, $140,000 per year for the first 3 years, followed by $60K per year. So we'll come back to that. Let's look at company options first here. So on the spreadsheet, you saw that we looked at Mass Mutual and Guardian, 2 of your 4 major mutual companies, which are 2 of my favorites. It is who our company primarily uses. So we discussed other companies and products. He asked about indexed universal life. I also mentioned smaller companies and why we don't use them or recommend them to the same manner we do with the major mutual companies. And the reason why is this. Here's exactly what we discussed. Is our company, Insurance Business Concepts, primarily uses Mass Mutual and Guardian, and we recommend any of the 4 major mutual companies, which are Mass, Guardian, New York Life, and Northwestern Mutual. The simple reason why is when you look at whole life insurance, and not illustrations, but real performance, what I have seen is those 4 companies have consistently delivered the strongest internal rates of return to policyholders. And this is based on actual performance, not just projections. So the proof is in the pudding there, you could put it that way. A big issue when it comes to whole life insurance sales in general, and this has gone on for a long time, is often people take out a policy based on what they see in that illustration. The product under-delivers. Expectations were set, you're going to have $1 million. Reality strikes, you have $600,000. And where I've seen expectations met more often are 1, when the policy is placed with one of those companies, but then 2, if it's designed properly, and what I mean when I say designed properly is with a base premium that is as low as you can possibly go, which also results in the strongest guaranteed values on the illustration. But with that said, so that's what we've progressed through in the discussion. Mass and Guardian we primarily use because they're two of the four major mutual companies, and they also give a lot of flexibility, which is nice. Just to give a brief overview on this, because we've got videos that provide a full overview, is if you set Mass Mutual up properly, a product with them, you can easily make payment adjustments without underwriting, one time per year, every year. The specific rider we need to attach is their LISR rider. If that is attached, a policyholder very, very easily can bounce the payment up and down. In his case, I can pay $140,000 year one, then $60,000 the next year, then back up to $100,000 the following. Then I can pay in, let's call it $60,000 for 5 years and go back up to $140,000 again. If that rider is attached, I just say, here's how much I want to add. Our company adjusts everything on the back end with Mass Mutual, and then the online portal updates, and you can send your money in. But the thing is that we have to be aware of there, we can do that one time per year on our policy anniversary date, which is when our premium is due, when they send you the annual statement and your premium notice. You've got a 60-day window to do that too. It doesn't have to be on the exact day. But Mass Mutual, one time per year, whereas Guardian is extremely flexible. He can commit to the minimum only, and then 100% at leisure, he can add money into PUAs. So a lot of people like that flexibility. In his case, he doesn't need it as much because he can really bank on this money coming in. But at the same time, what we want to take into consideration is if he goes with the higher end option, $140K per year, that's his MEC limit, how much he can pay in. Once his other business begins to cash flow, will he have excess funds that he wants the ability to add to a policy at leisure? If it's at leisure, meaning anytime he just does so through his mobile app, online portal, whenever, then Guardian is a great option to be aware of. If he says, hey, one time per year, I'm very comfortable with that, and I like Mass Mutual, a very large company, I'm comfortable with them, then Mass works. The point is just being aware of these options up front goes such a long way for so many people. Number 3, designing his whole life insurance policy. So, high upfront cash value, strong long-term performance, flexibility to bounce payments up and down, and then seeing the actual growth rate. Let me begin with the last point there. Actual growth rate, what does that mean? He brought up a really good question that a lot of people have. He said, okay, Steve, if I have a company that's paying me a dividend, is my cash value compounding by whatever that dividend rate is? So let's take Mass Mutual. They've got a very round dividend rate right now at 6%. If you've got $100,000 in cash value and your dividend rate is 6%, would you see 6% applied, 6% interest applied to that $100,000, which would result the next year you having 106? The answer is no. And the reason why is because the dividend rate is always a gross rate that is applied to one's policy after the insurance expenses, mortality charges, in short, everything that comes with the life insurance policy. So the follow-up question people ask there, or the question we like to ask for them, is what is the actual growth rate in the policy? And the terminology used in the industry is referred to as IRR, which stands for internal rate of return. I like to call that net growth rate just to make things simple. So we're going to look at that, but that was something that we did look at in this case. So let's look at the actual design of the policy. And if we go to option 2, we've got $140,000 per year going in for 3 years, and then $60,000 per year through the 10th year. And this is just an Excel spreadsheet. For all you know, I could have made these numbers up, which we never do. We pull it directly from the illustration software. With that said, let's validate it. So here's an illustration, a full illustration. Typically, you'll see between 13 and 20 pages here. Go back to the cover page. We've got valued client because we took his name off. Ledger statement gives us a clean breakdown as to where his money is going. Age 62 male, preferred NT, that stands for non-tobacco. This is the second best health class. Right in the middle, you've got standard non-smoker, which is what the majority of people receive, then regular preferred, and then preferred plus, which is the top health class. Now, when it comes to a whole life insurance policy, here's the most important thing to be aware of. The question I would ask if I'm you, if we flipped positions, or I'm just providing advice as far as what to ask your agent to make sure that the policy is set up in your best interest if cash value is your goal. Where is your money going? How much money does he have going into this policy? $140,000 per year for 3 years, and then $60,000 per year thereafter. So before we go down and look at the net cash value, the net death benefit, everything, what we want to look at is of that 140, let's begin just with the first year. So breakdown as to where the money is going in this policy. We see a total of how much? $140,000 paid into the policy. If this is you and you say, I'm going to fund it with $140K right out of the gates, where's it going? Number one, premium up top. So you see it underneath annual premium. So this guy right here is your base premium. Kind of an oddball number, $12,727. Where on earth did I come up with that? Where I came up with that is this is an illustration with Guardian, good old Guardian, and the maximum I can illustrate here with respect to PUA payments. PUA stands for Paid Up Additions Rider. Maximum we can illustrate is 10x the base premium. With the exception of the first year, we can actually illustrate up to 50x the base premium. Guardian will accept that. But in this example, since we're making consistent payments of $140K for 3 years, if I just take $140,000, divide it by 11, that's where I come up with the base premium, because we know that we can pay 10 times that in the PUAs. And one other thing, this PUA rider reads scheduled. A lot of times people will set it up where it's unscheduled. This way you're not billed for it. And this allows you to commit to the minimum amount and make additional payments at leisure. So you can commit to the base premium plus this actually. This guy is a term insurance rider. So the true minimum commitment would be those two combined. And we typically round up a little bit as well. So call that, if I just want to round up more, $15,000 or so. Not quite that much. But some other things I want to hit on. So where's the money going? Base premium. That buys him, in this particular case, a whole life death benefit of almost $260,000. If we stopped there, that would give him a MEC limit of between $18,000 and $20,000. He's paying in $140,000. That MEC limit. So if we go over that MEC limit, the policy becomes taxable. Specifically, what happens is the cash value grows tax deferred. If you never touch it, you don't have to deal with taxes. But if you ever want to access the cash value, specifically with a MEC, the gains will be taxable as ordinary income. So how we prevent it here, the MEC limit has a direct relationship to the total death benefit on a policy. So what we did here was add this guy, this target additional benefit, which is a term insurance rider, which is a cheap way, if you don't like the word cheap, a cost-efficient way to add more life insurance, which adds more MEC space. So $1.6 million is actually the minimum death benefit needed because that gives him a MEC limit of, guess what, $140,000. So we're minimizing the death benefit, minimizing costs in order to maximize cash value. I want to get as much of that payment directed toward the PUA rider in order to maximize the cash value, which will also give me the strongest guaranteed values as well. So breakdown as to where the money's going there. Let's scroll down here. As we look at this, you'll see all these values will match the Excel spreadsheet because we just exported everything from the illustration to the Excel sheet to make things simple. If we look at the other policies here, so here's our Mass Mutual product. Same thing, $140,000 per year going in for 3 years and then $60K per year thereafter. Where's the money going? different breakdown than what the Guardian illustration looks like, or I should say different format. Here's your premium, $14,000. 10% of the total desired payment. Total payment, but also total desired payment. Remember, he's got the ability to bounce payments up and down. Then we've got other riders, which consist of term insurance riders and PUA riders. We do have videos that provide a full breakdown on illustrations, but most important thing, premium, $14,000. Other thing I want to hit on here, death benefits about $1.4 million in this product, on this product. Bottom right-hand corner gives you your MEC limit, $140,000. So what this tells us is that this is the minimum death benefit needed to be able to pay in up to $140,000 per year. He's got $140 going in for 3 years. We can easily design this so we can pay in $140 for 10 years. So you can be very creative with the design there. So those are 2 samples there. Let's progress on now. So going back to the spreadsheet here, let's look at the comparison so we can see side by side what option he prefers. Beginning with the $75K for 10 years. What do we notice? MassMutual 10-pay policy. Year 1, you pay in $75K. 75 goes in, you've got $64,000 in cash value. That's a hit of about $11,000. The next year, you pay in $75,000. Do you get the full $75K back? You do not. You get less than that back. However, what happens the next year? I get my $75K back, plus a little bit more on top of it. It gets better and better each year. What yellow represents here is your break-even point, which means when you have equal or greater value in cash value than what you've paid into the policy in total payments since day 1. So here by year 6, he's paid in $450 and he's got $457, and this is specifically with MassMutual's 10-pay policy. With the Guardian L95 policy, the dividend option, the break-even is similar. Just about year 6, you've paid in $450, you're at $448. Year 7, you're positive. I want to add something here. Guardian's dividend rate is 5.65%. MassMutual's dividend rate is 6%. And if you look at New York Life's, they're 5.8%, and Northwestern's 5% flat. What I've seen is those 4 major mutual companies, at one point in time, one company has led the pack with the highest dividend rate and the best looking illustrations. In reality, I feel you could close your eyes and pick any one of those companies out of a hat. If all things are equal from a design perspective, you cannot go wrong with any of them. We've seen all of them deliver strong results to policyholders if it is properly designed. And you've got the indexed option, which will look better on the cash value side, simply because we're indexing the dividend in that example, but he can switch back and forth over time. It's a nice option to look at, but it is all hypothetical. Next option, $140 for 3 years, and then $60 thereafter. This does generate more cash value for a number of reasons. 1, he's got a lump sum going in, and 2, he's got more money going in. So in this example, we allocated a total of $840,000 toward the policy. The 75 for 10 years was a total of $750,000. So you will see a higher dollar amount here. So of course we will have more cash value, but you'll notice a little bit stronger values, particularly upfront when we look at the break-even point, because we're funding it with a lump sum. Just about there, year 5 with the Mass example. Same thing with Guardian. When we look at that, look at year 5. The values, they're not identical, but boy, are they close. You're literally within $14 there. The Guardian dividend option compared to the MassMutual 10-pay. When we look at year 10, the Mass illustration will begin to pull ahead on the cash value side. And the reason why has to do with the higher dividend rate. But again, we see those companies always go back and forth. Something I want to mention about this example is this policy has that minimum of about $14,000, the base premium plus the term rider. His MEC limit is also $140,000, which means he's paying in $140K years 1 and 3. But after year 3, if he wants to continue to do this, he can. but we're just modeling 60K because that's what he is very comfortable with in this example. What's he doing though? He's starting a business. He knows what he's doing in his business. If it cash flows, can he add more to this policy? Yes, because he's starting with a lump sum. If he says, hey, can I just continue to add 140 or maybe add 140 for another 2 years? Maybe I throw 100 in a couple years because it doesn't have to be all the way up to 140. Can he do that? The answer is yes. What if the opposite happens? What if his business requires a lot of cash? He has to keep investing more into it than what he thought because something happens. If you're a business owner, that something can be anything. You know what I mean? But what if he cannot pay in the 60K per year here? Because life happens. Does he have to pay that in? No, not at all. We can easily reduce that to the minimum. We can easily reduce that to zero if he didn't want to pay anything in after the third year. And it will continue to grow at an attractive rate. So the policy is set up for a lot of flexibility there. Last thing I want to hit on point number 3 is going back to the actual growth rate. Since he asked the question about the dividend rate and the actual compounding on the policy, we can highlight things like this. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.